Hey everyone, it's Mike Bonn coming from quarantine hotel room in Cancun, Mexico. Yep, flunked the COVID test. So I get to spend 10 days here, but we're going to keep going with this series on funding flips. So every first of every month, we go over funding flips, how to do that. Today, we're going to go over one of the most important things that's coming up more and more right now. Credit scores are becoming more and more important because large companies are getting into the fix and flip hard money space, and they're requiring more credit scores as their underwriting criteria. A lot of the small people still do not require credit scores, or at least look at credit history and everything, but it's coming more and more prevalent, and it will make a difference. It will make a difference on your income, the rates you, the leverage, everything and anything. It will make a difference. So this is important to understand and then go over. And we're just going to go through some of the basics. So as I said, the first week we go over how to fund a flip. We went through the basics right away, where the money comes from, who are the lenders, experience hurdles. This is all about credit. If you missed any of those, you could go to our YouTube channel, hardmoneymike.com. You could always subscribe because we have a lot of great videos out there, a lot of informational, fun videos that can get you some education, get going, because our goal is to get you free in 3. What that means, it can mean anything, but typically it means you have the choice in 3 years to do what you want because of real estate investing. We've helped a lot of people become free in 3, and some of them have completely freed themselves of anything and any worries. And other people are just now able to fund their own flips, and they can do 2 or 3. Whatever that is, you have to have a choice in 3 years what you're going to do, not relying on where you work, what you do, anything like that. That's our goal. And that always has been our goal. We've been doing this for 21, almost 22 years in another month. We've helped thousands of people. We've done thousands of loans. So our whole goal is to make you successful, because that makes us successful. You do successful projects, you want to do more, and hopefully we can help you with those. It's not a requirement, but it is. So we're going to go over what is credit score, why it's important, why it matters, and 3 quick, easy ways to boost your score. These are all basics, fundamentals of understanding the credit score. So why is there a credit score? Because it's all about the financial institutions coming up and going, I want to lend to more people. I don't know those people. So what can I use to determine it if I can lend to them? And one of those is credit score. So they came up with this system that goes through people's credit history, payment history, all that other stuff, and determines what it is. It's ever changing, always changes. Each industry has their own kind of credit score. Each company kind of has their own. So it's a little confusing. But in the end, it comes down to a few things. And those few things are how you're paying and amount. So that makes up almost 2/3 of your credit score. So the easy thing is payment history. How are you paying? Do you have bankruptcies? Do you have anything else like that? Those are the easy ones to figure out. The other one is the 30% is amount owed. Two people who owe the same amount, maybe they both owe $1,000, will get different scores here because of what they have available. So it's not only what you use, but how much you have available. So let's look at an example. Let's say 2 people have $1,000. They owe $1,000 on their credit cards, and one, that is all they can borrow because they're maxed out. They have no more usage available. That person will get a lot lower score than someone who still owes the same amount, $1,000, but maybe has usage availability up to $5,000. So they have other credit cards. They have a credit card that can max out or whatever that gives them that extra $4,000. So they have more ability to get more debt if something comes up. And it also shows that they are not using all of their credit. So that's a big item right there. And that's one of the things that we focus on because it can be tweaked legally to help your credit score go up. So the other thing down in the far right is your credit mix. Credit mix, all that is do you have a car loan? Do you have a HELOC? Do you have a mortgage? Do you have credit cards? Do you have other personal loans? Do you have and have had other credit besides just one credit card? Do you have multiple things that you have used and it shows up. And then the other one is length of credit. You can't do much about that. Maybe you've only been in the credit, just received credit, in the last 1 to 5 years. That compared to someone who has it for 15 to 40 years, they just get a little bit of boost because they've had it longer. And there's not much we could do there. And the other thing is new credit. And that's everyone hears about, don't pull my credit because it'll affect my score. That's where it comes in. So it can affect it. So maybe you're at a 740 credit score and you pull your credit to maybe get a new credit card, a new car, or something else like that. Then you go apply for a loan. Your credit score will drop, can drop. Just depends on how many inquiries and how much that goes down on what will happen. So credit inquiries do affect it. Just doesn't affect it as much as some of the other items out there. So ideally, the credit score that will get you the best rate, give you the most options, keep your leverage down, which we'll go through in a little bit, is 700 plus. And we'll go through, here is kind of in the mortgage industry what they look at. So there are different measurements and scoring out there. Like if you have Credit Karma, once again, they have their own credit scoring system. It will not match up specifically to FICO for mortgages. Car companies have a different scoring system than mortgage companies. So it's all very different, but it all comes down to that same mix. As long as you're paying on time, you have good usage, you're going to be fine. So, but really between that 740 and 800 is where the very good, that's where most of your options will open up. As you go down, like if you go down to the 580 to 620, your options are limited and your leverage may be also limited. So the better the credit, what we're going to show here is the better, the easier, the more profitable you will be. So it will determine your path. So if you want to take the easy path or the hard path, your credit score will matter because number one, it'll impact your rates. So what are you paying? And your rates will determine your cash flow. Because if you're paying a higher rate, maybe you're paying $500 more a month. You're just giving $500 more a month to the bank or the lender. That's a big impact on your cash flow. But the other part that impacts your cash flow is leverage. So the lower your credit score, the lower your leverage, which means leverage means how much money you have to put into the deal. A better credit score will mean lower leverage, meaning you put less money or have to bring less money into a deal. So let's just say you have a $300,000 project all in. With good credit, max, maybe you have to put in 10%. Sometimes you could get zero down. If you don't have good credit, they're going to ask for 20 to 25% down. So you may go from 30 grand to 60 grand to maybe 70 grand. So leverage matters, but also loan availability and who wants to lend to you. You have so many more options when you have a great credit score because there are just more lenders who are looking for people with that type of credit score. So you're going to find better products. You're going to find better terms, all of those things. And all that just makes it easier. It's already tough enough that you're finding properties, finding contractors, maybe finding tenants, and or selling that to the seller and dealing with that. All of those things, why make this hard? You can make it easier just by raising that credit score. So here's 3 easy ways to raise that credit score. Number one, like we talked about, is the availability and usage. So if you have $1,000 and you only have 1,000 available, that's going to hurt you. So number one, you could go to your credit card company and say, hey, can you increase that to 2 or 3,000? You get it to 3,000. That will impact your credit score dramatically because now you went to about 33% usage because you only owe 1,000 and you have 3,000 available. So call your credit card company. If you plan ahead, you could open up some other lines. Don't use them, but just open them up. The other thing is if you do close old credit lines, you got a new card and you're going to get rid of your old one, don't close it. Don't close it. Just get rid of the card because that availability on there shows that you have more available. The credit score will dramatically go up. Or you could also, number 2, is get authorized, which that means that you become an authorized credit user on someone else's account, maybe a family member, a brother, a sister, mom and dad, friend, whatever it is, get authorized on good accounts. Good accounts means they've been paying on time, paying for a while, and have low balances. So you've hit just three things there. Now you've added an account that has history, that's paying good, and has a low balance. So you've hit three of the things. So if you get authorized in someone else's account, that'll help your score. It typically will not help you with lenders who are looking for credit lines, but it will help you with your credit score. And it's an easy way to do it if someone will allow you to get authorized on their account. The other thing is to go private, as I call it. So how the credit scoring works is it changes almost daily because the items that are reported change all the time. So let's just say you have 3 credit cards, and one reports on the 1st, one reports on the 10th, and one reports on the 20th. So what happens is your statement cuts on the 1st. That's when they report that credit card to your credit bureau. The other one, statements on the 10th, and that's when they report it to the credit bureau. And then on the 20th, the same thing. So at different times, different things are reporting to your credit, and it's changing your credit score. So one of the things we always say is wipe those out, borrow money from someone or someplace to, get all your credit cards paid up and off for at least the next 60 days while you're applying for credit. That will dramatically increase your score, and you'll be able to go from there. And you can get that from family members, or you could just even take it off a HELOC. On a HELOC is a lot better than a credit card. So there are little ways, there's little tricks. We could always help you. We have a lot more information out there. Like I said, you could go out to our YouTube channel. There's other credit videos out there. There's a lot of other information. There's some really fun videos out there. So go out there, subscribe, look at it. If you have a deal, or if you want to talk specifics, email us, call us. We'd be glad to help. We're going to come up next. We're going to go over in the funding flips section. We're going to go over different hard money lenders, who they are, what one is best for you, and how do I find them. So as always, glad you joined us. Happy you joined us. And we wish you nothing but happy investing.